Hello and a very warm welcome. You're watching News 9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. As usual, to my left is my colleague Suyash Maheshwari. Suyash, a sea of reds in the markets this morning.
Yes, Shweta, Indian markets have extended their losing streak to the second straight session now in a row. And this was on the back of a negative handover from the US markets. Now US markets corrected sharply last night. All three indices, namely the S&P 500, Dow Jones and Nasdaq, saw a correction of about 1.3% to 1.9%. Now this was on the back of a stronger than expected jobs data that came in yesterday, which also fuels or strengthens the case for another rate hike that could come in the November policy meet or perhaps the December policy meet. In fact, Dow, Shweta, has turned negative for the first time in 2023. It was down about 0.4% or so, whereas S&P 500 and Nasdaq are still boasting healthy gains of about 10% and 24%. Now coming back to the Indian markets, the Nifty opened at below the 19,500 levels, and the sensex also saw a weak start to the day, opening just above the 65,300 mark. Since then, the market has corrected further, and Nifty has also slipped below the 19,400 mark, which was seen as a next crucial support for the index, whereas the sensex is trading just above the 65,000 mark. Now talking about the sectors, the banking pack, Shweta, was among the worst hit. It was down about 0.83%, and it broke below the 44,200 levels, which was seen as a crucial support for the banking index. The index has been one of the worst performers in the recent consolidation or let's say correction that the market has witnessed. Auto was another sector which continued to witness selling pressure. The auto pack was down about 1% or so this morning, and this was on the back of another 1% fall that we saw yesterday. Among other sectors that are under pressure was a usual suspect, the IT pack, which was down about 0.76%, the media pack, which was down about 0.83%. Pharma also saw some profit booking, and it was down about 0.67% this morning.
All right, thank you for that lowdown. Let's quickly get in our guest, Kranthi Bathini of WealthMills Securities, joining us on the show. Kranthi, thank you so much for taking time out. I think, taking off from where we left off last week, and the conversation was obviously about consolidation. How sooner will the Indian markets consolidate? Do you see this happening now with markets opening in the deep red once again this morning?
Between our conversation, market it shown a turnaround in between, but the global cues are spoiling the party and mood at this point of time. The cues that are coming from the global markets is quite negative, and they are creating the extra pressure on Indian market at this point of time. Of course, 19,500 was the level we were watching as a consolidation zone, but last 2 days and today, the kind of negative turn market have taken is creating extra pressure on the markets in the medium to short term. But one thing is very clear: these kind of sharp dips in Indian markets definitely are offering a very good opportunities for the investors. We need to look for the next level for Nifty around 19,200. This is a very crucial support. If anything below, it creates some kind of extra negative sentiment in the market. So these are the crucial levels we need to watch out for in the medium to short term, next few days and few weeks. We are running into the earnings season. The earnings season is going to start from next week. So those are the cues that can give some extra support for the market. At this point of time, the global cues are negative, and also the FIs have been little bit sideways last few days and few weeks. That's creating some kind of jittiness in the market at this point of time. Overall, the long-term setup is in line. Okay, nothing to worry about with respect to the domestic macros and the growth of India story. It's very much in line, but the knee-jerk reactions are coming mostly from the global cues at this point of time.
Okay.
Now,
Okay,
yeah.
before I let my colleague Suyash take over, I just have one more question for you. With Nifty breaching the 19,500 support level, are you worried at this point in time? I understand you mentioned the next support level will be at 19,200, but does that raise red flags for you, even as domestic cues are favorable at the moment and we're awaiting earnings season to kickstart?
Shweta, if you see on a day-to-day basis, okay, it does impact the market sentiment, okay, on a relative shorter term basis. Whereas the medium term to the long term, the market outlook is quite firm and strong at this point of time. It's not creating any kind of cause of concern at this point of time. Still, we can pursue and conceive this market knee-jerk reaction as a short-term impact of the global cues, but anything below from these levels can create some kind of extra pressure on the market and can create negative sentiment in the market. At this point of time, okay, there is no room for the negative sentiment on a longer to medium term basis,
Okay.
but relatively on a daily basis, it does create pressure on the markets on a intraday basis or on a weekly basis.
Now, Kranthi, I also want to get your view quickly on the Nifty banking pack. Now, the banking index has, come under pressure lately in the last 2 weeks. In fact, it has been one of the underperformers or one of the worst performers in this recent fall. Even today, the market has, the Nifty banking index has broken below the what was seen as a make or break support of 44,200. And yesterday's crash also, was largely driven by losses in HDFC Bank and ICICI Bank, which corrected about 1.2%. Now, what's your overall view on the banking pack? Do you expect selling to continue there, given that we have broken that crucial support, or a bounce back could be in the offing?
Suresh, if you see on a 3 years perspective or a 3 months quarterly perspective, banking sector have been one of the outperformer in Indian markets, and in fact, one of the key favorite sector for the foreign portfolio investors and also for the domestic institutional investors is the flavor of Indian market is banking and financial services. So the public sector banks have been outperforming, and the private sector banks have been in a consolidation phase from last couple of months. So rising global bond yields and also the higher interest rate scenario, that's creating extra pressure on banking and financial services right now at this point of time. But on a relatively longer term perspective and a medium term perspective, we believe India's banking franchise story is a very strong story at this point of time. So for a longer term investors who want to enter into the markets, banking and financial services offers a very good entry levels at this point of time also. In fact, if at all any dip that comes in the banking and financial services stocks are concerned, it's a good opportunity for the investors to enter into banking and financial services in a staggered manner. And one other reason for banking and financial services is it is pursued as the epicenter of growth, the banking and financial services. So if the India has to have a strong domestic growth story, banking and financial services is going to play a very key role in this entire theme of Indian growth and macros are concerned. So on a relatively longer term perspective or a medium term perspective, banking and financial theme is in line. And in fact, right now, despite of high interest rate environment in India, the public sector banks have been outperforming, and right now the growth, the credit growth is in 2 digits at this point of time. So this is a short-term knee-jerk reaction with respect to banking and financial services is concerned.
Now, Kranthi, another sector actually that has in fact outperformed the market, and we have seen some strength building there is the FMCG pack. Now, FMCG pack was the only sector that opened in the green yesterday. It is the only sector that opened in the green today. Why are we seeing a bullish momentum building over there?
Sure. One thing is some kind of defensive play is taking place with respect to FMCG sector is concerned. And also the month-on-month robust GST numbers also can reflect in the indirect taxes, that is FMCG, one of the key sector. So that shows indirectly the strength in the sector. And also the domestic growth story, the consumption story is still in line. That's where some kind of bottom fishing, what we are witnessing in the FMCG sector is concerned. So at this point of time, on a relative basis, okay, the long only money has been chasing these kind of stocks and sectors in the medium to short term basis.
Now, I also want to touch upon the World Cup. Now, World Cup starts tomorrow, and in the run-up to the World Cup, we have seen a bit of a rally playing up in the hotel stocks and the media stocks. Especially in the hotel stocks, we have seen that the average room rate has gone up through the roof in the last year or so. First, it was the G20, now the World Cup, and now the festive season. Any particular sector that could, be in the limelight once the World Cup starts? Or I mean,
there is Suresh, mainly the hospitality sector, the hotel stocks like Indian hotels have been outperforming, and the other majority of the stocks in hotel sectors have been performing. In fact, QSR, the quick service restaurant stocks also joined the rally at this point of time. There is a robust growth in terms of the food and beverages business also right now. We can see a complete robust growth with respect to the QSR business is concerned at this point of time. We can call it as a revenge buying kind of atmosphere we can see with respect to the hospitality sector is concerned at this point of time. And we have a new stock that got listed last week. That is Samhi Hotels, okay, which also covers a strong set of properties like Hyatt brands and all it covers. So these kind of stocks also attracting some kind of buying interest at this point of time.
So Kranthi, do you have any dream team or stocks that perhaps one can look at to play this theme?
At this point of time, Suyash, the stock valuations are little bit stretched at this point of time. Of course, the stocks can still deliver from this level also, the mid-teen returns from this levels also, like Indian hotels, one of the strong brand in India, okay, investors with a moderate risk appetite and also low risk appetite can buy this stock at every dip.
I also quickly, before we move to stocks specifically, want to get your view on the IT pack. Right ahead of the earnings season, we know FPIs have pumped in over 7,000 crore rupees in the last couple of weeks into IT stocks. Is this the right time to buy? Should one wait for results to kick in? What's your view on the IT pack?
And also a lot of global brokerages have shared positive commentary, and they have raised target price on several of these stocks.
Yeah. Shweta, on a longer term perspective, okay, definitely IT can be bought at every dip. If you see, the Nifty IT index have doubled in last 5 years, if you have to give a broader perspective with respect to IT is concerned. So on a medium to short term basis, of course, the global growth concern, the US economy, recession worries, all these factors have been playing as a spoil spot with respect to the large cap IT stocks are concerned. So if the investor have a relatively on a longer term horizon, definitely in a staggered manner at this point of time also, one can pick the large cap IT stocks with a longer term perspective. Whereas with respect to the medium to short term, definitely there is going to be headwinds with respect to the margins, and also the new order books are concerned with respect to the IT stocks are concerned. If you say for a shorter term perspective, definitely one need to exercise caution with respect to IT is concerned, but definitely for a medium to longer term perspective, I say yes to IT as large cap IT stocks are concerned, but investors need to take their positions in a very staggered manner.
Now, also quickly want to get your view on, RBI's policy decision that will come out on October 6th. Now, there seems to be a consensus there that RBI will perhaps hold the rate at 6.5% and, maintain its hawkish stance of withdrawal of accommodation on account of inflation cooling off and economic stability. Do you agree with this line of thought, and is there a probability that we could, RBI could negatively surprise us by perhaps increasing the rate, given that there is a talk of rate hike going in the US?
Suyash, with respect to our Indian Monetary Policy Committee is concerned, they always give a lot of importance to the growth is concerned and a medium to longer term process. It's a very challenging task for the MPC, the central bank, to manage one hand the growth and the other hand manage inflation, especially in a market like India and the emerging market space. So what I'm going to pursue from the MPC commentary is extremely, the forward-looking statements from the Reserve Bank governor is extremely crucial, how they are going to pursue the inflation. At this point of time, we can see one hand, there was a key concern of food inflation in the last monetary policy is concerned. At this point of time, the food inflation has been in a little bit cool off mode, and monsoon also by and large it is a sufficient monsoon we witnessed. But right now the spoiling spot can be at this point of time the rising crude oil prices. Of course, crude oil has been, when we interacted last time, it was in a vertically, it's going up. Right now, last couple of days, we can see some kind of softening of crude oil prices. But crude oil is the important parameter at this point of time. So RBI also consider the rising crude oil prices in terms of their inflationary measures are concerned. But what I can see is probably RBI can maintain the status quo at this point of time. They are not going to rise any kind of interest rates. There will not be any kind of negative surprises. But in the last, there are the other levers RBI have in their hand to control the liquidity. Like in the recent MPC, they used some other parameters. So by and large, we can expect the rate hikes cannot be there. We can rule out the rate hike. Otherwise, it's going to create a pressure on Indian markets further. But they are going to maintain a status quo with respect to the rate hike measures are concerned.
Okay, status quo is expected. Before we move on to stocks specifically, advanced decline ratio for the month of September has also come in well, and this despite the fact that FPIs have constantly pulled back. How are you looking at the volatility and the fact that majority of the stocks still continue to do better, still advancing as opposed to the ones that are declining?
Shweta, if you have to define the FPI money that's coming into India, there is a hot money that comes with respect to the global cues, with respect to the indexation concern. Whenever there is a negative sentiment, whenever there is a negative global cues, this hot money try to go out of India. But on a relative basis, the long only money is going to stay in Indian markets. This is the money that's going to be there on Indian markets for based on the Indian thematic, Indian growth is concerned. So right now what's happening is when the FPIs are pulling out the money from Indian markets, the relative reaction from Indian market is when you compare with the other previous rallies and previous market seasons. This time, the negativity of FPI flows has been relatively very less on Indian market because we have strong domestic cues right now. The mutual funds have been sitting at a good amount of cash at this point of time. The domestic institutional investors are quite strong. So whenever there is a gap created by the foreign portfolio investors, that gap is getting filled by the domestic fund flows are concerned. And PMS and other HNIs and the retail flows have been quite strong despite of the current the negativity our FPIs turning as the net sellers. So that gap has been getting filled by the strong domestic cues at this point of time, Shweta. That's where the Indian market is showing its strength and robustness in terms of the advanced declines ratio and also the bottom fishing what we can see at every decline.
All right. So despite FPI pull-out, advanced decline ratio for the month of September has improved, mainly on the back of the fact that there is still faith that domestic investors have in Indian equities. But let's quickly move on to stocks specifically. Adani is in news. The Adani Enterprises particularly is in the news, Suyash.
Yes. So Abu Dhabi's IHC investment holding company has raised its stake in Adani Enterprises by 0.06%. Taking its total stake to 5.04%. Now, as of October 3's closing price, the stake buy of 0.06% is worth around 163 crore, and the total stake of IHC in Adani Group company is worth somewhere around 13,700 crore. Now, IHC said that the inherent strength of the airport business, the data center business, and green hydrogen and various other verticals that are being incubated under Adani Enterprises are poised to uniquely capitalize on India's robust growth story. Now, Kranthi, last time when you were here, we were trying to determine, IHC had just at least they were in talks to offload their stake in Adani Energy and Adani Green. So we were trying to determine who the winner or the loser of that deal was. It seems like Adani clearly is a winner here, right?
If I have to answer the question, the time will tell on a longer term perspective. Probably the IHC of Abu Dhabi, they are quite strong with respect to the infrastructure theme that's emerging in India, and Adani is the key beneficiary with respect to the whole infrastructure theme that is emerging. Adani Enterprises is concerned, as you rightly mentioned, there are strong incubating businesses, the airport business and the green energy business. These are the incubating businesses with respect to Adani Enterprises is concerned. So this gives us these kind of news that do impact the relative performance of the stocks on a regular basis. But we need to have a much a bigger perspective at this point of time with respect to Adani Group is concerned. The stocks are quite resilient despite of the positive and negative news that do surfaces on a day-to-day basis at this point of time. So what we can see is investors with a relatively high risk appetite, these group stocks are suitable.
Talking about Adani Enterprises being a major incubator of business, back in 2015, the group carved out its ports, energy and transmission business, and subsequently the green power business as well. Now, do you expect, it to perhaps potentially look to spin off other businesses, in the next few years or so?
Definitely, Suyash. That is the important theme and the play that plays around Adani Group Enterprises. Adani Enterprises is concerned. So we can see in the coming few quarters or in the coming days, coming months, we can see the incubating businesses or data center businesses or the airport businesses can be demerged business models for a period of time. And the interesting theme is the group has been reinventing themselves to create new incubating businesses in Adani Enterprises. So this theme has been played very well to Adani Group and Adani Enterprises in the past, and we need to wait and watch what kind of interest that's going to derive for a period of time. One thing is the sentiment has been improving with respect to Adani Enterprises is concerned at this point of time, because they have been making their effort to reduce their debt, and the other hand, they have been increasing the cash levels to fund the future growth. That is the right thing they are doing in the medium to short term.
All right, let's also quickly move on and quickly wrap up what other stocks are in news, Suyash.
Yes, Shweta. So Vedanta was another stock that has been in the news for quite some time now. Now Vedanta,
But the demerger is not coming through anytime soon.
it is the shareholder approval is pending. We'll see how that plays out. The last time around, you know, when the group was looking to delist its businesses back in 2021, it was a shareholders that you know, pulled it to a hard stop there. So shareholders approval will obviously be keenly eyed, but Anil Agarwal is also, you know, yesterday he was talking about selling the steel business of the company, and he expects to complete that sale by, you know, the end of this fiscal or so. And if you'll allow me to take it back to Kranthi for another question. Now, I mean, there has been talks about, you know, Vedanta selling off some of its assets to, you know, function or service its debt, and especially the debt payment of about 2 billion that comes next year, you know, 1 billion or so in January and another billion in August. Do you expect more, you know, Vedanta Group to sell more businesses?
Yeah, Suresh, it can be possible because to serve the debt, and right now as the rising global bond yields are concerned, it's going to create some extra pressure for Vedanta Group on a relatively shorter to medium term basis. So they have going to carve out some kind of businesses. Value locking is essential for this group is concerned at this point of time. So yes, as you rightly mentioned, the point to ponder is they were in the plans to delist the Vedanta Group from Indian markets, but the kind of strife they received from the institutional investors. Okay, right now they are in the mood to value unlocking at this point of time. They on a robust note, they want to demerge the companies into 6 different entities. So the one reason of concern for this group is the uneven nature of their announcements, how they are going to make the plans. This is the one key concerning area for Vedanta Group. Of course, there are some real assets are there. There is value in their assets, but the spoiling spot for this group is the uneven nature of their announcements and the corporate governance. Earlier also we discussed some kind of news agency also posted some kind of news with respect to their corporate governance is concerned. So this is the cause of worry for Vedanta on a relatively in a medium to longer term perspective.
All right, so Vedanta, there lots happening. We don't know if demerger will come through just as yet, but Anil Agarwal-led Vedanta has already announced its plans to demerge its businesses. We'll of course have to wait and watch out for more details as they will be emerging. Kranthi Bathini, thank you so much, sir, for taking time out and for speaking to Newsline. To you too, Suyash, thank you very much. But shifting focus now to another interesting story that we're tracking, and that is with respect to India's GDP growth in financial year 24. Will it be 6.5%? Will it be 6.3%, 2%? Different estimates coming in. But Karthik Malhotra walking in, and perhaps Karthik, you could help us understand. NITI Aayog this time around is saying it's 6.5. Just literally 24 hours ago, World Bank said 6.2, 6.3. Various estimates, but all of them targeting a growth rate of over 6.2%.
Absolutely. So, Shweta, hi, good morning to you.
Good
I
morning.
think what we are really seeing is that NITI Aayog is not saying something new. It is just reiterating what the RBI has said already. And RBI's growth projection for India's GDP for FY24 is pegged at 6.5%. Now, NITI Aayog is just reiterating that, and I think the response comes, the statement comes maybe, you know, a couple of hours after the World Bank report, which suggested that India will grow at just about 6.3% or so. Now, it's a different matter what statistics and what calculations different agencies take into account while estimating growth. But one thing is for certain, that even 6.5% is not enough.
Not enough.
Because 7.6% to 8% is the target for us to become a $5 trillion economy by the turn of the decade, and to become a developed economy by 2047, which is 100 years of our independence, termed as Amrit Kal, you know, the last 25 years up to 100. So overall, whether it's 6.3, whether it's 6.5, whether it's 6.8, even if it is 7.2, something that we achieved in the last financial year, it's well short of the target of 7.6%, which we require to grow. Now, what are some of the stumbling blocks which Of course, the NITI Aayog has also identified, but our common knowledge as well. We've seen the PMI index that released yesterday showing that month on month, the manufacturing output has slowed down. It is still growing, not growing at the same clip as it was earlier. What are we arriving at? We are arriving at a fact that our export story still needs to be beefed up. We don't have enough exports going out of the country. Now, these exports are both services exports, which is IT, the back office work that Indian IT majors do, as well as the pure manufacturing exports. Why is this slowing down? It is simply slowing down because the world economy is not in a great shape. So, overall, India continues to be a bright spot. Overall, compared to its peers, India continues to be a leading major global economy. But is that number enough? That number is definitely not enough. What are some of the other party poopers? We could see inflation, with rising crude prices.
You often talk about the GDP calculation formula on the show. Perhaps on that calculation, in that mathematical formula, exports being one of the laggards, what are the other issues?
So, okay, so let's repeat that formula, right? Y is equal to C plus G plus I plus X minus M. Y being the measure of GDP is equal to consumption plus government spending plus private investments plus the delta of exports minus imports. If you have a current account surplus, your exports will be higher than your imports. India has a current account deficit, and hence the exports are lower than imports. So, a widening current account deficit spoils the whole equation of GDP calculation. What are the other elements? You have consumption. That consumption story is looking good. You look at what is happening with housing sales, you look at what is happening with car sales, you look at FMCG products being bought, you have a festive season coming up. Despite inflation, you have the consumption story doing well. Government spending continues to be robust. Government spending on infrastructure, on creation of physical assets is going to continue, is going to do the heavy lifting for the foreseeable future. Private sector investments, I think, yet to, reach the optimum level. Simply because we are in an election year, private sector will want to wait for stability of policy, will want to hope for continuance of existing policy measures before making large capital investments. But overall, if you look at the other potential party spoilers, in India's already not the best number on GDP growth coming, you are looking at inflation. You have the RBI MPC kick-starting today until Friday, and Friday is when we will see if there is any change in the rate stance that the RBI has taken, which is a pause right now. So inflation could be one. Inflation could become a double whammy with rising crude prices globally, and of course, consumption, given it is an election year, given we are entering a festivity season, is likely to pick up, and hopefully, the 6.5% figure should be achieved. But even if it is 6.4, 6.3 or 6.7, 6.8, we are well below the target of 7.6.
All right. And if we are to be a $5 trillion economy by the turn of decade, we are expected to grow, or should be growing at 7.6% or so. That's not happening, at least not in the upcoming
financial year. And every year that you miss that target, the burden of growth for the next year multiplies. So, it's not a simple arithmetic calculation that we grew 0.2% lower this time, a 0.2% is going to offset that. It'll be a multiplier of 0.3, 0.3, 0.5 or something.
Absolutely. And NITI Aayog, they're predicting that India will grow at 6.5%. Now, we were talking about government expenditure. That has constantly remained robust. In fact, government is also in a fresh policy move looking to incentivize urban poor and urban middle class people by giving them an interest subvention on buying a home. So,
that's right.
So a lot of expenditure there on infrastructure, of course.
Yeah, so this is typically not capital expenditure, this is subsidy expenditure for the government. What this new scheme is likely to do, and this is the report, in the Financial Express this morning, not verified by us independently, but what the report suggests is that this new scheme that the government is likely to roll out, the panel has already given its go-ahead, the cabinet is likely to take it up soon, and if this goes through, we are looking at an infusion of 60,000 crore rupees in interest subvention by way of subsidy. What is interest subvention? It is primarily, the government is able to help you with subsidy, on an amount which reduces your rate of interest for your loan.
Right.
Which means if you're seeking a home loan at 9% per annum, with this government scheme coming in, this allocation of 60,000 crore rupees, a subvention of 3 to 6% on that hypothetical 9% loan would be applicable to you, which means your 9% loan could actually cost you just about 6%, anything between 3% to 6%.
Okay.
Right. So that
what
is
does that really depend on, the delta? Whether it's going to be 3 or 6?
I think it is going to depend on A, your income group, B, the
Right.
size of the house that you're purchasing.
Okay.
So the 6% subvention up to a limit of 50 lakh rupees of loan. Right. So now this scheme is specifically for the urban poor. The
Who's an urban poor? Am I an urban poor?
I don't think so, Shweta. I think that's not.
Who's okay, urban middle class perhaps?
No, urban poor are those who are below the poverty line but are living in urban areas, right?
Urban
So
middle
urban
class?
slums, for example,
Right.
The slum dwellers, the urban dwellers, migrated labor which comes to a city to work but does not live in a pakka house and does not earn the minimum threshold of of what classifies them as baseline poverty but are below the poverty line. Those are the urban poor. They happen to live in urban areas and hence urban poor. Now, but the calculation is specifically on the per capita income and family income.
And it's also open to urban middle class. I hope I fall in that category.
No, I don't think this interest subvention would be open to you because you would be squarely in the middle class, and this is a scheme which is
class.
So this is for the urban poor, dedicated for the urban poor. It is likely to be a scheme which is going to replace the Pradhan Mantri Awas Yojana Urban, PMAYU.
Right.
So PMAYU and CLSS, which is credit linked subsidy scheme, which the government already rolls out, not specifically targeted to urban poor but BPL across the country, has already subsidized as much as 1.47 lakh crore rupees. So this 60,000 crore rupees comes in addition to that, taking the whole corpus to about 2.1 lakh crore rupees as subsidy. And once the scheme rolls out, if it does, then it is likely to replace the Pradhan Mantri Awas Yojana Urban.
Okay, so the scheme there to, in a sense, incentivize people, especially urban poor looking to buy a home, on a loan of up to 50 lakh rupees and interest subvention of 3 to 6%. It's good money, and 60,000 crore rupees earmarked for that scheme.
So you don't know how many people will eventually be beneficiaries of this scheme, but
which
I
is
think the moot
which is
point
one
is
of
that
the
that you are leading into this this strive to be a developed nation is getting fulfilled because you are now offering schemes for people to work a little harder, take a loan from a bank, repay it at a smaller interest rate, but at least live in a pakka house.
I think the entire argument will rest on the offtake of the scheme, because that has been a concern with the Pradhan Mantri Awas Yojana as well.
They have seen beneficiaries of about 11 to 12 million households have availed of the PMAY and CLSS schemes. So almost 12 million people, which is 12 into 10 lakh, 1.2 crore people have availed of the subsidy previously. So there's no reason for this to also not be picked up, specifically because this is targeted to the urban poor, and that of course is a sizable population. Given the overall construction and migration of labor that happens for the construction business, I think it definitely is a large enough size for not just Delhi but all urban areas across the country to avail of.
All right, and let's quickly move on from perhaps a subsidy for housing to a story of internet giant, or rather a story of edtech giant that we continue to track. Byjus, my colleague, is okay. My colleague hopefully will walk in, and perhaps we'll discuss what Byjus. What the latest concerns with Byjus are at the moment. We do know that they have missed the audit deadline, but Byjus cleaning its house, letting go of people, hoping to get rid of its debt. A lot happening, Karthik, on the Byjus front.
A lot happening, but honestly, Shweta, I think the Byjus mess is continuing, and there isn't any closure on the mess that Byju Ravindran and the top management and the board of Byjus finds itself in. Very simply put, I think we are right now staring at a situation where, hi Amit, good morning. We are staring at a situation where you have a $1.2 billion term B loan which is yet to be paid. Now, this repayment is likely to happen in 150 days from the time the sale of Epic and Great Learning, two platforms that Byjus had acquired in the midst of the pandemic to expand its business. Once that sale happens, that sale is likely to raise up to $1 billion worth, 800 million to $1 billion worth, and that would be used to repay at least a large chunk of that $1.2 billion term B loan. Now, But what is it that Byjus has done in the interim? Of course, news of layoff, up to 4,000 more people likely to be laid off from the company, reducing its already shrunk 35,000 workforce to about 31,000 is something which is likely to happen. Consolidation of businesses is happening, shutting down of offices is happening. But what is not happening is that the audited financials for FY22 are yet to be released. They were supposed to be released in the month of September, but for whatever reason, even after the change of auditors, Deloitte walking out, you haven't really seen that deadline being honored by Byjus. We've seen, a change in CEO, you've seen a change of guard, you've seen a new board, you've seen these new grand restructuring plans of shutting down and laying off and consolidating and selling businesses and wanting to repay the loan. But what is happening with the books of FY22? And I think that is the root cause of all problems, because there is something in those numbers which, for whatever reason, Byjus does not want to make public, it seems.
And
hence it becomes even more relevant for MCA to come down heavily on unlisted organizations of the scale of Byjus,
raised huge money,
and who have raised huge money, who are accountable to their shareholders, even though they are not retail investors and in the private domain, but you're responsible to your shareholders, you're responsible to your employees, and at some point you've got to come clean. Absolutely. And at some point you've got to come clean, and if you're not coming clean voluntarily, then there needs to be stricter action in terms of MCA coming down and making these corporate governance norms absolutely mandatory for unlisted companies as well.
All right, Amit Ranjan is back with us here in the News 9 studios. Amit, welcome back. What's the hold up with Byjus?
There's no good news with them, it seems. So they are laying off employees. They need to raise 1.2, as Karthik mentioned, of their term loan B, TLB, and they are selling off 2 of their businesses. There was news of an IPO with Akash that is still in the waiting, so that could raise some money, but they need money, and nothing still seems to be going right for them. They have made a lot of changes, new auditor, new people on the board who have seen situations like this and dealt, whether it is Mr. Rajneesh Kumar or Mr. Mohandas Pai. But probably it is going to be a long haul for them before they...
But what Byjus is also stating in the same breath is that by end of this financial year, by 31st March, it is likely to be profitable. I wonder how. Where are the books to suggest that you are going to be profitable? I mean, we haven't seen 2022 books, we haven't seen 2023 books, half of 2024, FY24 is over, and the company wants to be profitable by selling its assets, by restructuring, resizing, doing all of that, and wants to turn profitable. But how? Where is the roadmap, and where is the data to support that there is a course correction underway?
All right, absolutely time for perhaps Byjus to come clean. The new CEO, Arjun Mohan, trying his best to restructure, to clear off the debt from the books, but all of that on the back of the fact that the audit report for financial year 22 hasn't come out just as yet. We are already right in the bang of financial year 24. The quarter 2 is almost over. It's over, in fact, and therefore Byjus and pressure mounting on Byjus. But moving on to a story that we're tracking by the way of growing tourists from India, prospective tourists, not just going to perhaps various places within India, but also going out. $15 billion worth tourism from India, and these are all outbound tourists to various foreign destinations. Europe, perhaps the most most sought after destination. What are we picking up?
Yeah, so 15 billion, big number, and it is likely to grow at over 11% compounded annual growth rate up to 2032. The domestic tourism also has seen a big up with Airbnb basically bookings rising. The big destination that India itself has become is in the MICE segment, that is meetings and incentives, conferences and exhibitions. So that has seen a big uptake. It is the fastest growing segment in the world, India, in the MICE segment. So yeah, tourism is just one of the sectors where India is the fastest growing, but it is one.
All right, tourism fastest growing, in fact, in the MICE segment, particularly, which is the meetings, incentives, conferences and exhibition, on the back of the fact that India and the government is investing heavily in building that infrastructure for MICE sector. But before we close this bulletin, important story that is breaking by the way of a fine which has been levied on Amitabh Bachchan for misleading advertisements. What do we have? Karthik.
So, Shweta, we just read the story, while entering the studio. So, not too many details, except that what we know right now is that CAIT, the Confederation of All India Traders, has gone up in arms against the superstar Amitabh Bachchan as well as Flipkart, since the two of them have jointly released, Flipkart has released with Amitabh Bachchan being the endorser or the brand ambassador, so to speak, of the big billion days sale that Flipkart is on the verge of launching in just a few days from now. And the complaint from CAIT suggests that there has been specifically misleading communication in that advertisement, in which Mr. Bachchan is playing the role of perhaps a retailer. I saw 2-3 ads of Flipkart. They did not organically come on my feed, but from what I saw, I don't think it is putting sellers in any bad light. It is about the smartphone category. It is specifically about the prices of smartphones being offered by Flipkart, perhaps as as a run-up to promoting the big billion day sale. But from the ads, they seem fairly okay. It doesn't maybe these are shorter versions put out there on social media, but from what I saw, it's just ads promoting smartphones as a category, great prices on smartphones on Flipkart during those sale days. Beyond that, I don't think there is any misrepresentation of sellers or suppliers as claimed by CAIT. But yeah, CAIT is saying that a fine of 10 lakh rupees should be imposed on Mr. Amitabh Bachchan for being in, cahoots, so to speak, with Flipkart.
It's an ongoing sort of issue between the brick and mortar business and the online e-commerce platforms.
And of course, CAIT being the crusader for the brick and mortar, for the mom and pop stores, always living in this fear that, the big daddies of e-commerce are going to come and eat our lunch and eat our dinner and eat our dessert.
Has it?
It hasn't happened yet. We've seen online grow, we've seen offline also grow. In the absence of online, offline might have grown faster, but hey, times are changing. We want to use 5G, we want to use smartphones. We want to talk about the cheapest data. What do you use that for? At some point, you may have a federation going against OTT apps and saying that, it's hampering the movie business. Of course, times are changing, businesses evolve, and you've got to live with that and fight the real fight, fight a logical fight. I think a 10 lakh rupee fine on Mr. Bachchan or on Flipkart is not going to make any dent on anybody, and it's not that they're going to just write a check and clear it. It is going to perhaps, be taken up legally. It is going to get into a battle of its own legally.
But I believe the name Amitabh Bachchan is going to get eyeballs.
Even
though the fine is extremely minuscule
of CAIT perhaps, but I don't know.
I think 10 lakh is minuscule.
The ads seem fairly innocuous to me. I didn't notice anything untoward towards the suppliers or the sellers of smartphones.
All right, we will try and push that ad to you if it's still out there. I know there were calls to bring down that ad by CAIT, but so far what we know is that Amitabh Bachchan is under fire for that advertisements from Flipkart, which CAIT is not very happy about, is miffed, and has asked for a fine of 10 lakh rupee to be levied on the superstar. But with that, we have run out of time on this bulletin. Thank you very much for watching.
engineering